In this section, we move from token incentives to business reality. DePIN networks only work when hardware costs, customer pricing, protocol margins, and operator returns fit together. The core question is simple. Can the network survive without subsidies? So far, we've built from DePIN fundamentals into the economic engine, marketplaces, incentives, tokenomics, and sustainability. Now we get practical by connecting pricing to infrastructure costs, operator ROI, and network margins before moving into governance and stakeholder alignment. DePIN is different because growth depends on assets in the real world. Someone has to buy hardware, install it, power it, maintain it, and eventually replace it. Token rewards can jumpstart supply, but they are not a business model on their own. The real test is whether customer revenue can cover operating costs and still give operators a fair return. When that balance works, the protocol becomes sustainable instead of temporarily subsidized. Hardware economics start with CapEx, but the device price is only part of the decision. Contributors may also need to fund installation, accessories, shipping, taxes, insurance, financing, permits, or site preparation. These add-ons can change the payback period dramatically. The important habit is to model total initial deployment cost using real supplier quotes. Then compare that full upfront investment against realistic future rewards, not best-case projections. Deployment is only the beginning. Profitability also depends on recurring OpEx. Power, connectivity, maintenance, monitoring, support, and failures. Downtime, damage, and theft should be treated as expected costs in the model, not unlikely exceptions. Payback period is the operator's break-even clock. Start with the upfront hardware cost, then estimate gross monthly earnings from real network demand and token rewards. Next, subtract recurring costs such as power, connectivity, repairs, platform fees, and taxes. What remains is net monthly cash flow. Divide the initial investment by that number. If hardware costs $1,200 and net cash flow is $100 per month, payback is 12 months. The shorter that window, the lower the operator's risk. Purchase price is only one part of hardware economics. Every device has a useful life, and its value declines as it ages, breaks down, or becomes outdated. Utilization matters just as much. If customers are not using the capacity, the asset may never earn back its cost, even if it was cheap to deploy. Strong DePIN planning estimates depreciation, demand, replacement timing, resale value, and the risk that better technology makes the asset obsolete early. Pricing is the bridge between raw network capacity and real customer demand. Developers may prefer usage-based fees because costs scale with API calls. Enterprises may prefer contracts because budgeting and reliability matter more than flexibility. Spot markets can improve utilization, while credits or token payments may fit crypto-native users. The goal is not to offer every model. It is to match price structure to customer behavior without adding friction that slows adoption. The best pricing model matches how customers experience value. Usage-based pricing fits variable consumption such as API calls, storage, compute, trips, or energy. It feels fair, but revenue can swing. Subscriptions trade precision for predictability, usually through tiers and included limits. Enterprise pricing adds commitments, SLAs, compliance, and support, creating stable revenue but longer sales cycles. In every case, price must cover cost to serve and remain attractive versus alternatives. DePIN payment design separates what customers experience from how the protocol settles value. Spot markets price capacity dynamically, which can help balance supply and demand, but may create budgeting uncertainty. Credits and stable prices hide that complexity, so customers can plan in familiar terms. Behind the scenes, the network may convert usage into token settlement and operator rewards. The trade-off is efficiency versus friction. Market exposure can improve incentives, but it can also make adoption harder. Pricing in DePIN is a balancing act, not just a spreadsheet exercise. Cost-based pricing asks what the network must earn to cover infrastructure and margins. Value-based pricing asks what customers gain, such as lower costs, better coverage, resilience, or performance. Competitive pricing asks what alternatives charge, from cloud providers to telecoms or utilities. The right price sits where users can adopt quickly, suppliers still earn enough, and the network can remain sustainable over time. Network margin is the protocol's real economic breathing room. Start with customer revenue, then subtract what must be paid to operators and what the protocol spends on infrastructure, security, governance, and growth. If operator rewards are too high, the network may grow supply, but capture little value. If they are too low, operators leave. The sustainable path is when real customer payments, not just token emissions, fund both hardware ROI and the protocol's long-term operations. Token rewards are not the problem. They are a tool for getting early supply online before customers arrive. The risk appears when incentives keep attracting operators faster than real usage grows. Utilization falls, rewards get diluted, and operators leave disappointed. A healthy DePIN economy changes its income mix over time. Subsidies shrink in importance, while customer-paid revenue becomes the main reason operators stay. Before trusting any DePIN model, pressure test it. Ask what happens if token prices fall, utilization ramps slowly, hardware fails more often, or energy costs rise. Then compare ROI across optimistic, base, and conservative cases. The real question is not whether the upside looks exciting. It is whether operators still have a reason to stay when incentives shrink. Strong networks can adjust pricing, manage costs, and survive slower demand without losing customers to cheaper alternatives. The lesson is that DePIN economics must connect three pieces: hardware ROI for operators, pricing that customers understand and accept, and network margin that can fund rewards and protocol operations. When those stay aligned, incentives become infrastructure. Next, we'll look at governance, how those rules are managed over time.